Good morning or good afternoon, wherever people are tuning in from. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. And joining us today is Michael Cheah, Head of Fixed Income and Portfolio Manager. And also there are a couple of people from America First Wealth Management as well. Jim Monahan, our COO and CCO. Cleveland Ashley, Regional Marketing and Sales Director, and Paul Monahan, who is a Product Strategy Analyst. Turning to the slide, this is our third webinar, by the way. We like to do this on a periodic basis to reach out to our investors and people who are tuning into us. We also put together a weekly webcast with our investment outlook that usually is available Monday mornings, and just covers what happened in the previous week and what's expected to occur this week and our investment outlook. And we try to make it informative and timely as possible. And one of the things that's unique about America First is that we are a small boutique mutual fund company, and we make ourselves accessible to our clients, which is something that most advisors will not be able to get that type of access at very large firms unless they have a huge multi-billion-dollar book of business. So this is our standard disclaimer, and it basically says that we're not giving you any investment advice here. Our opinions are subject to change as market conditions change. So our agenda today is to try to keep this to under an hour. We're going to have some prepared comments for about 30 to 45 minutes, and then give plenty of time for Q&A. So for those who are tuning in who aren't familiar with us, here's some bios. Basically, we have three senior individuals, Mike, Jim, and myself. The three of us worked together at AIG Sun America for about a decade. And collectively there, our team managed in excess of $50 billion. So America First is an interesting opportunity for us at this point in our careers. We consider ourselves to be at our primes, but we are quite seasoned. We have collectively have over 100 years of investment experience. So we bring that to America First Wealth Management in an investment boutique format. And we're motivated and highly incentivized to turn around this business and to grow it. And just to give you a sense of the history, our parent company, DSS, likes to buy assets in different types of industries that are in need of new management teams or injection of capital. And in our case, America First needed a new management team. So that's where the opportunity for Mike, Jim, and myself to come in to pretty much affect a turnaround here. So, and also recently we changed the name from, it used to be called DSS Wealth Management. We changed the advisor name to America First Wealth Management because the America First funds, it just seemed to be consistent, and it didn't make sense to have it used to be called DSS America First, but if America First is first, it shouldn't have anything preceding it like DSS. The other thing that occurred very recently was shareholders approved a new board of independent trustees, and we felt that we needed a new board with much more experience in the investment industry that was attuned to making the changes that we felt would effectively turn this business around. So we currently have four funds. One is an income fund that invests in dividend-paying equities and fixed income. And what's unique about it is it offers an attractive monthly distribution yield. And I'll talk a little bit more about that later in terms of what we're making a little change there that I think investors will like to hear about. We have a risk-on, risk-off fund, which targets investors that are looking for higher return and higher risk and long-term capital appreciation. We have a fund that this historically has had the best performance record. It's more of a quantitative structured type of product that invests in large cap stocks that have a buyback program. And that's been obviously very attractive as many large companies who are in strong financial position have been supporting their share price by buying back stock. And we'll talk more about that a little bit because there are changes there that require us to modify the mandate of this fund, which I think is pretty exciting. Lastly, we have a defensive growth fund, which invests in equities that are typically defensive or non-cyclical. And that has unfortunately been our least attractive product. Although historically it had done very well, it had fallen out of grace. And we're going to be doing something with that, which I'll talk about shortly. So our not so new, and I call it the OG, original generation new team, consists of Jim, Michael, and myself, and these are our roles. And historically, America First was purely a quantitative type of strategy. And that strategy fell out of favor, I think, along with other quantitative approaches in recent years. And we felt that to turn this around, we should use the strengths that we bring to the table. And that's top-down macro, fundamental bottom-up, quantitative, and technical analysis, because that's the experience and strengths of the current team. And I touch upon this. Our goals are not to become a giant mutual fund company, but we want to have a small family of funds that meet the needs of most investors at various stages of their lives. So we're coming from low risk principal protection to capital gain and income generation and capital gain and a shoot the lights out high risk, high return type of strategy. And we want to be accessible to advisors that would otherwise not be able to reach out to anyone that's managing money and making decisions, and just answer any questions that they have, any concerns. Our goal is to build a consultative long-term relationship and treat us as an extension of your professional investing staff. And we will try to be timely and reach out to people as needed and make ourselves available. So our goal is not to get to a point where we're, as we have done in our past career, grow to be multiple billions in assets under management and just become more of an asset gathering type of business. We want to be a consultative, performance-driven, balanced, and someone that our clients and investors develop a deep trust. And we hope to learn from our investors as well to understand their concerns. So that's how we view our goals. What's ahead of us? We have filed with the SEC to convert two of our funds. One is the defensive growth, which I mentioned has gone out of favor, and to convert that to a total return bond fund to be managed by Mr. Michael Cheah here. And also what's happening in recent years, in terms of large cap share buybacks, the Biden administration implemented a 1% excise tax on share buybacks, which began this year. And there is strong evidence, bipartisan, on a bipartisan basis, to increase that excise tax to as high as 4%. And there's been some indication that that might even go as high as 10%, the excise tax. So we want to be ahead of that because we think that this anomaly of large cap buyback driving performance for that niche is going to fade. So we want to still take advantage of buybacks, but we want to open it up to what we call different alpha trending factors that have been academically and proven by practitioners to add value. Some of these include things like spin-offs, large companies like S&P 500 companies that spin off a division and the stock is spun out, and most investors, especially institutional ones, don't know what to do with those spin-off stocks. Those share prices typically drop, but then they become attractive at some point. And if you catch them at the right point in valuation, they also tend to be unfollowed and uncovered by sell-side analysts. So if you capture those, you can, develop alpha by being in good companies that have been spun out. And typically those management teams are heavily incentivized to grow and build the business. Other things might include momentum stocks at the right point, small cap stocks, for example, at year end, after there's a big sell-off, there's typically a small cap January effect that we have played very successfully in our past careers. So these are some of the things that we want to be able to include in our Alpha Trends Factor Fund. The income fund, as I mentioned, we have operated historically without any formal distribution policy. And this fund has paid monthly distributions since inception. And we felt that it's important because we heard from a number of investors who were concerned that there was no policy around this distribution, and they were concerned that it would be cut at some point. Our income fund, it's kind of unique because it pays a higher payment that is typically supported by the dividends and interest stream. So in part, some of the distribution could be a return of capital. And for those who are familiar with annuities, it has an annuity-like component because of that. Because some of the distribution consists of return of capital, it can tend to be viewed as a annuity product. However, it has the benefits of not requiring the investor to pay a commission, which is typical of annuities. And also it has the freedom of investors to exit and take their money out whenever they need. And also for their heirs, they receive the full value of the fund. And for those who don't need the high current distribution income, they can simply reinvest the distribution and accumulate additional shares. So that could have a very substantial and profound wealth generation effect if people are reinvesting. And at the right point in the cycle, as we know, especially when interest rates are declining, dividend-paying stocks and bonds do very well. So it has that kind of a unique characteristic, which we think is unique. We are, so we're formalizing our policy by saying that every year in December, we are going to announce a monthly distribution rate for the following year. And while we can't guarantee it, we can state that we'll be within our best efforts and given normal market conditions that we honor that distribution rate. And as I noted, the fund has paid monthly distributions uninterrupted since inception, which I believe is July 2010. So it's a very attractive income generating product. So we're, these are three things that we're changing, and we hope that investors will find it interesting and exciting. Turning back to what we want to touch upon today, just to highlight again the agenda. Sorry for flipping on this. Since today is the presidential debate that's occurring this evening, we thought it would be nice to spend a fair amount of time talking about each of the candidates' policies and what the implications are for investors. And typically what Mike and I like to do in our weekly presentations is we begin with our outlook or conclusions based upon our analysis first, and then we support it with additional detail. Okay. So going to the policy positions, we've listed the different issues here and each candidate's positions on it. And rather than read through each of these in detail, I think it's important to note that there's some policies where there's some overlap and others where there's almost opposite opinions. So I think that sets up interesting investment dynamics and implications. And at the end of these policy positions, we'll talk about where we think some of these opportunities or potential concerns lie. So top in the list, Federal Reserve. The Harris administration said that they're going to be pretty laissez-faire or hands-off and let the Fed do what they've done in the past. The Trump administration, Trump has been quite vocal on interest rates. He's also pro-Bitcoin and crypto. And he also announced recently that he's going to appoint Elon Musk to head an audit of the entire federal government. So the comments are typically status quo with Harris, and Trump will definitely be rocking the boat. So there will likely be some volatility driven by Trump in terms of some of his prognostications if he were elected president. I'm going to lump personal and corporate taxes together because it seems to be consistent that for Harris, the looks like the tax implications, although she has promised that there'll be no taxes on family income over 400,000. The big question mark is what she has said about capital gains. She made some comments about capital gains on unrealized gains. And I'm not sure how that's done or implemented. If people hold assets and haven't sold it, how do you mark to market? And if there's a unrealized loss, do you get that back? Obviously, it creates some crazy accounting maneuverings or estimates, and I think it'll create a lot of concern if that happens. Whereas in the Trump administration, obviously wants to extend his 2017 tax cuts indefinitely, which are scheduled to sunset soon. And he and also Harris announced that no taxation on tips. Trump is extending that further, no taxation on Social Security benefits, deduction for expenses on newborns, and the reduction of IRS enforcement. So on the tax front, it does look like Trump would be better for the markets. Corporate taxes, we're definitely looking at higher corporate taxes under Harris, and the same or even lower under Trump. And even under Trump, even though we're looking at lower taxes, the question is, as I know Mike talks about this, what do you do about the fiscal spending? Because that seems to be out of control. The public debt is up to 35 trillion. On tax revenues of $3 trillion, we're looking at 1.1 trillion in interest expense just on the public debt right now. So that may not be a sustainable situation. So with either administration, we do have to look for ways for them to increase revenues, cut spending, or do both. Trade and tariffs. Both administrations are clearly tough on China. With the Biden and Harris administration maintaining most of the Trump tariffs that were implemented in his first term and higher EV tariffs. Trump wants to increase tariffs on China to 60% at least, and then 10 to 20% on the rest of the world. So needless to say, both are tough on China, and that probably has implications on imported goods from China for both corporate and consumers. On healthcare, it looks like to us the Harris administration is definitely tough on drug companies, giving the government has power to negotiate drug prices with Medicare, I'm definitely seeing some reduction in drug costs for consumers. Trump, on the other hand, said that he wants to bring down drug prices, but he really hasn't explained how. So we do look at both administrations being tough on big drug companies, and there's a lot of the big drug companies are at risk of losing significant revenues, especially those who are seeing their exclusivity periods on large drugs. This would be AbbVie or Merck. They're at the risk of losing huge amounts of revenues once their patent exclusivity ends. This also creates huge opportunities for biotech, as the big drug companies are literally investing a lot of money to develop new pipeline drugs and investing in biotech right now. I'm not going to touch too much on immigration and reproductive rights because these tend to be less of a factor in the markets. Just on immigration, I think a big question is, what obviously both are going to try to slow down the wave of migrants we've seen. Trump has said that he's going to deport as many illegals as possible, and that creates a big question mark. Does he really mean it? If he does, it creates a lot of civil and social strife. For us, the real question we have is the migrant labor is here. It obviously has a beneficial boost to some parts of the economy in terms of labor, but the overall impact on labor is uncertain, given what each administration is going to be doing. Reproductive rights, I'll just flip over that. And by the way, this investment deck is available for anyone who would like a copy of it. Education, won't touch upon that. Energy and the environment. Both administrations are almost opposite. I think it kind of depends upon whether or not the Harris administration is going to be extremely protective of climate change and the Green New Deal. More recently, she has said that she will not ban fracking. And if she can convince people that she won't flip-flop on her policy prognostication there, then it probably is good for energy services. On the other hand, the Trump administration basically said, drill, baby, drill. He definitely wants American energy production to be independent of foreign influences. From an inflation standpoint, that might be the best policy for reducing inflation because energy costs are just a huge factor in almost all components of inflation. So a huge drop in energy prices would be beneficial for reducing inflation pressure. I'm going to lump these all in one category: NATO, Ukraine, Russia, Middle East, China, and North Korea. And I kind of lump it together because the policy positions in these areas have huge implications on military budget spending. And that is clearly one of the largest expenditures of the federal government. So, and I would say that Harris is more of a status quo with the current positions going on, with the exception of the Middle East, where she wants to hasten a ceasefire. Trump clearly wants to reduce U.S. expenditure militarily, wants to reduce commitments to NATO. He wants to get a peace deal done as quickly as possible, Ukraine and Russia. He said he will support Israel, but he also wants to push them to finish up the war. The only area where I think the U.S. will increase their expenditure militarily will be with respect to what they do in the Pacific versus China. And obviously, the administrative policies are very tough in terms of tariffs, and they're also being tough in terms of how they respond to China militarily, especially as it deals with Taiwan. Then lastly, in North Korea, Trump is seeking détente, trying to ease the pressure. He's the only leader that's met with Kim Jong, I'm sorry, Kim Jong-un, not Jim Jong-un, twice. Whereas Harris administration is same old, same old. So summarizing the victory implications of each candidate, obviously Harris would be higher corporate taxes and potential reduction of corporate earnings. And it's kind of unclear what her real plans are to boost the economy, how much will be continuation of Bidenomics, and what's going to be changed. And to be fair, she was kind of put into this position all of a sudden, and I think her policy advisors and herself haven't fully formulated how she's going to differentiate herself from Biden and what her unique plans for stimulating the economy will be. And that's why this debate this evening will be very important, because I believe she's got to be clear and articulate some of those policies tonight. Like I said, if she promises that fracking won't be banned, that'll be good for energy services. And we believe that the military spending under her policy will be likely to maintain or increase with continued support for NATO and Ukraine. Trump victory implications would be beneficial in bottom lines by tax reduction, but we don't know if specifically what his plans are for deficit reduction. The public debt is likely to grow and create pressure on inflation and long-term interest rates. So it might be a feel-good moment in the beginning. We could be paying for it at the other end with higher inflation and interest rates. Energy services, I mentioned, possible reduction in military spending. And also cryptocurrency will get a boost because Trump said he would be an ardent supporter of crypto. So that kind of creates some new opportunities to consider. Summarizing my market outlook, I'm focused more on stocks, whereas Mike's focused on bonds. Near term, we think September's going to be a positive month. Historically, most Septembers have been the worst month of the year for stocks, except in election years, where 62.5% of the time September has yielded positive returns. And we're gonna go with that record because it is an election year. So we think that the recent pullback is a correction and a broader upward move. And the Fed is also poised to reduce interest rates when they meet on the 18th. And Mike will talk more about what that means and what his outlook is, because I consider Mike to be the expert there on the interest rates. We like that recently we've seen a rotation to value stocks and positive action in small caps. That's very encouraging because this broadening out is good, because for the earlier part of the year and last year, stock market returns were dominated by the Magnificent Seven names, which are now about 35% of the S&P 500. So this broadening out, we feel, is bullish. Long-term issues are rising public debt and interest service. But we think that the new administration, regardless, they're going to have to address that, because if we don't, the continual reduction of U.S. debt by foreign entities and central banks will be a problem. So the U.S. has to apply discipline there. So either administration will have to address that. The market will force their hand. The other thing that we think will be very stimulative for the economy and benefit stocks overall is the rapid adoption of AI across pretty much all sectors of the economy and all companies that we've talked to. And they're really seeing some material benefits. So we continue to see that investment in AI will stimulate and benefit stocks. And we also feel that the best opportunity to reduce inflation will be the lower energy costs by increasing domestic energy supply. So we hope both administrations will be actively pursuing policies that do that. I'm not going to touch upon all of these details, but these are weekly market stats that we typically show. The Russell 2000, and this is quarter to date, we see positive returns from Russell 2000 and the Dow. and also large value stocks. So this is the broadening out of the markets that we like to see. Year to date, equity returns are obviously very strong, but just this broadening out, we think is likely to continue. So it'll be better for stock pickers to find ideas versus trying to ride the Magnificent Seven. We thought this chart was pretty interesting, and thanks for Paul Monahan for sharing this. This AI value chain. We like the hardware infrastructure space, but there's still continual heavy spending and investment. We like the fabs, networking companies. We own Broadcom, we own NVIDIA, we own Dell. Data center infrastructure, we own a lot of utility companies that are the beneficiary of the higher energy consumption. We also own this company here called Vertiv, which is one of the leaders and partners of NVIDIA in liquid cooling of these data centers. So these are huge area of spends, and we think all of these companies here will participate and do very well. Software infrastructure is very interesting. We own Oracle. We're a little cautious in this area because there's a lot of high competition. It's hard to know who's going to be the clear leader here. This is just the chart of the S&P 500. So this pullback we consider to be a buying opportunity. 10-year Treasury yield has been declining sharply, as everyone has seen. We're now below where it was year end. Yield curve, the bottom purple one, is as of Friday. We can see a drop in the yield curve. Top line is end of June. Blue one's end of August. And yellow one was beginning of the year. So we see that the current yield curve has dropped a lot. Was still inverted, which is the short end is higher than the long end. Historically, that's portended recession, but if the Fed does what they do and they drop the short end, that'll have a dramatic impact on the shape of the curve, and I'm sure Mike will talk about that. And then I'm going to turn it over here to Mike now, and thanks for listening to me.
Thanks, Dan. So I think the economy is still very strong, and I'll show you some chart, and we'll reiterate when the Fed cut rate. And when we look at the, go back one slide, please. And when we look at the Fed funds contract and a 2-year note, the market is pricing in a lot of Fed cuts already, right? And for further interest rate to drop here, we would have to see a hard landing. And then finally, the fiscal deficit is out of control, right? Next slide. Next. So when we look at the Atlanta Fed model, the Fed GDP now, we are now tracking at 2.5%. 2.5% is obviously too strong for this economy because the potential GDP, which is a speed limit for US GDP, is 1.8%, right? So as we are growing above that 1.8%, we are running out of the natural resources, the natural number of workers, and so on, and that is underlying inflationary. Next slide. So we have seen this U.S. home sale data surge the highest level since May last year. And next slide. If the Fed cut rate aggressively, the mortgage rate would drop, and that would also fuel another round of the housing market going up. Next slide. And well, you know what? Let's make another bubble, right? So we have seen the housing bubble back in the before the great financial crisis. Real estate bubble burst, and that's simply because when you look at the blue line, that is the index for home prices, and the red line is the average hourly earning. When you see a large gap like this, it means that housing is less affordable based on the people's income. So when we look at recent data, we see the spike up in the blue line. and a very reluctant increase in the average hourly earning. So if you squint your eyes, you can see that the gap between the blue line and the red line now is much bigger than before the great financial crisis. So, well-fed, cut rate, and we're going to have another run up in the housing market, and hopefully average hourly earning can spike up to narrow the gap. If we don't, then this sector is worth watching very, very closely. Next slide. So this is the PMI, manufacturing and the service PMI. You can see that we have a drop to 47.5 for the manufacturing PMI, but the service sector is still running pretty strong, right? Next slide. And this chart shows the worst of inventory destocking cycle is likely behind us. And you see the uptick recently. We need a lot more inventory building before we get into a recession territory. Next slide. And the recent Fed beige book is showing that some districts are reporting slower job creation. In some places, it's even negative, meaning that there's no growth. Next slide. And we have seen how the non-farm payroll came in at 142,000, which is far from recessionary levels. Right. Next slide. And average hourly earning has a slight picked up, right? And next slide. And this is a very interesting chart because when you look at the red line layoff, we are not seeing any spike up that would signal likelihood of a recession. I think it's understandable because if you were to put yourself in the shoes of any CEO who was thinking of laying off some workers 2 months, 3 months ago, now would have to think twice because the Fed is going to cut rate. If the Fed is going to cut rate, then they could avoid the recession. So why fire workers? Because you let the worker go now, you might not be able to get them back when the economy grow back again. So this is kind of interesting because the mere action of the Fed talking about cutting rate and actually cut rate will prevent a recession, right? And we have seen in the past how a recession here always happen when companies fire the workers, meaning they fire their own customer. So if they're not going to lay off people, then it's unlikely that we get a recession. Next slide. So this is to show you that the debt burden on the consumer is pretty light, right? So there's a lot of room for people to want to borrow money to spend, right? Nobody like to cut back on their spending unless they're forced to, right? And if they're able to borrow, they will borrow to spend. Next slide. And here we have US consumer borrowing rises 25.5 billion, the most since late 2022, right? Next slide. On inflation, we see that the tips inflation break-even on this chart, it shows a 5-year. You get a similar picture when you look at the 2, 10, and 30. The break-even inflation now is 2%, meaning that the market is expecting that the Fed will be able to bring inflation down. So the tips has priced in a lot of good news, right? Next slide. And here we are seeing something similar to the average hourly earning. We see wage growth improving across all income group, right? So there's really no reason for the consumer to cut back on spending because they have jobs and the wages are going up and they can borrow money to spend, right? Next slide. On monetary policy, right? So a repeat that the market is confident that the Fed would be able to hit the 2% target. Next slide. Oh, there's a mess up here. Next slide. Next slide. All right. So now on this monetary policy, right? It's important to reflect back how in 2022 the Fed was quite late in raising rate, right? You see the dotted vertical line and you shift it to the left, you can see that they could have raised rate when inflation was running at 3%, 3.5%, 4%, 4.5%, right? They could have raised rate at any of those points, but they were very late in the raising rate. So my fear is that this Federal Reserve may be biased towards allowing inflation to go up, meaning that they will tighten slower, as is evidence in 2022, and will be quick to cut rate the moment they see that inflation have come down, right? So if they are wrong, they cut rate, the economy reaccelerate, inflation goes up, then with back-to-back two mistakes, that is going to erode the current Fed credibility, and that in turn could hurt the stock market. In turn, could hurt the dollar, right? Because foreigners would perceive that you don't have a central bank that is prepared to do whatever it takes to make sure inflation doesn't go up. Next slide. So to put it into perspective, right, you see that the unemployment rate has risen slightly, and now it is just touching the natural unemployment rate without inflation. And typically, it takes a run up in unemployment rate before we get a recession. At this point here, we are in a Goldilocks scenario where we are having enough people who are unemployed at exactly the same level as the natural rate, right? Next slide. So I'm watching the initial claims number very carefully. Obviously, with the COVID number, the chart is a mess up. But let's look at the next chart, where I removed the COVID numbers. And the point is where we are now, we are at 238,000, right? And if you were to look at the previous start of each recession, you see that the initial unemployment claim have gone above 350,000 before we get into a recession. So 238,000, we are far, far away from any need to panic over a serious job loss situation. Next slide. So here we have the Fed Fund contract, and the market is now pricing in 114 basis of rate cut by the end of this year, and expecting the Fed funds rate to go below 3% by the end of next year. So this is clearly extremely aggressive, right? Next slide. And what we are seeing now, as Dan mentioned just now, we are seeing some re-steepening of the curve. Some part of the curve is less inverted. And here, this is a 10-year and 2-year, right? While an inverted yield curve predict a recession, it is the uninverting that would trigger the inflation. Sorry, trigger the recession. So where we are now, we have seen some, but not enough normalizing the curve that would trigger a serious recession. Next slide. So this is the yield curve, similar to what Dan has shown you. And you see that the 1-year, 2-year has moved a lot, but the well, thank you, Ryan. I understand that you have to leave. Okay, I hope to see you the next time. So the 10-year rates have dropped by less, only 53 basis. Next slide. A bond market. So we are seeing a lot of speculators getting short in the treasury market, and maybe they're seeing the same thing that I'm seeing. Next slide. So here we have the TLT that has a pattern of trying to break above each of these rounding pattern, but fail each time. Right. Next slide. So as Dan was saying just now, the interest payment is running at 1.1 trillion. And if the Fed were to cut rate by 2%, the interest payment will still rise to 1.2 trillion. And if they don't cut rate, then it'll be 1.4 trillion, right? So let's take a number like 1.2 and bear that in mind, how big this number is. Next slide. The 1.2 is going to get larger because of the lag effect. Now that we have the interest rate rising, have risen, that is going to cost more for the government to borrow as they have their debt previously issued up for maturity and for refunding. Next slide. So here, the chart showing 31% of all US government debt outstanding, or 7.6 trillion, will mature over the next year, right? Next slide. So how much is this 7.6 trillion? Well, you compare it against the 1.38 trillion deficit in fiscal year 22, right? That is a pretty large number. And of the 7.6 trillion, we have put aside 1.2 trillion for interest payment alone, right? Next slide. And you will see that on this chart, the blue line, which is deficit as a percentage of GDP, tend to spike up when the unemployment rate has gone up, which makes sense because when your unemployment rate goes up, that is when we have a recession. And during a recession, there will be more government spending on unemployment benefit, and there will be less tax collected from corporate as well as income tax. The interesting thing is that when you look at the recent number, right, you'll see that unemployment is very low, economy is very strong, but the debt, but the budget deficit, they have not come down, right? So the scary thing is that if and when we do get into recession, the green dotted line will go up, and it will pull the blue line, the deficit, much higher, right? So that would mean more supply, more borrowing, right, by the federal government. Next slide. The dollar, well, we see that the dollar, yen, and the US-Japan bond spread correlated nicely. And looking forward, one would argue that this interest rate differential would narrow as the Bank of Japan raise rate and as the Fed cut rate. So as the interest rate differential narrow, this would mean that the dollar would decline, especially against the yen. Next slide. And this chart shows that Japan has a substantial net asset investment abroad. And if they're losing money on the dollar yen position, they may have to unwound this trade. That means selling dollars and buying yen. Right. Next slide. Energy. Energy prices have come down quite sharply in the last few days. But if you look at the global observable oil inventory, you see that we are having very low inventory, right? So if there's not much inventory, it's a lot harder to see oil price falling further from here. Next slide. Gold, next slide. Gold, essentially, we still have this situation where the foreign central bankers are buying gold. And next slide. And the men in the street have been selling gold on the way up, and now they're just beginning to buy back gold. So I'm interested in oil because it affects inflation. I'm interested in gold because it affects the bond market as well. Right. Next slide. All right. So, well, Dan, over to you.
Yeah, that brings us to our Q&A section. I think, Cleveland, you may have some questions that some of the advisors have sent in. And also, before we get to that, just want to mention that the rest of the deck has a lot of the data points that we put on our weekly, and they're also available for anyone who would like a copy. Please contact Cleveland for a copy of that. Let me just, at this point, I'm going to actually halt the Q&A. Actually, why don't we do some of the Q&A, and then when we have some live Q&A, we'll halt the recording of that. Cleveland.
Okay, I think this is a good question. You pretty much covered it, but I think it's still worth asking. What is your overall investment philosophy?
Sure. I kind of touched upon it, but let me more formally state that our investment philosophy is a multifaceted one, and it's based upon our strengths that we've developed over our collective 100 years of experience. It's top-down, bottom-up fundamental research, technical and quantitative analysis, and we are disciplined in following all these techniques of our craft, and we are also consummate continual learners because the markets change over time, opportunities enter, and we have to quickly assess and understand what the implications and ramifications are. So if I just say that in one sentence, we're multifaceted, and we are continuous learners, and we pay attention to what's happening in the markets and try to assess the implications for our current investment holdings and positions, and we continually look for opportunities as they emerge as the markets change. Okay?
Yes, that's great. And as far as one discussion I had with the advisor is right now, and this might be a question for Mike as well. Right now, is it a good time to, with rates going down, trending down, good time to lock in CDs, bonds? A lot of advisors have clients that live off this fixed income and they're enjoying 5.5%, and they don't want to be caught like back in 2008, 2009, when the rates went down. So just what advice would you have for advisors to tell their clients?
Well, the first thing I will say is that be very careful if you want to do yourself. People who had bought a TLT, a very famous ETF that invests in treasury bond from a maturity of 20 to 30 years, they have seen how the TLT have lost 50%, 50, right? It is an extremely risky vehicle, and people have been burned. So it's one of those things that, although we call this thing fixed income securities, the income may be fixed, but the price can be very, very volatile, right? Before you do it on your own, you should consult a financial consultant who can understand the threshold that you can take, and whatever is it, nobody want to lose 50% of any investment.
Yeah, I would add to that, Cleveland, on the whether or not investors should lock in on the lower rates with short-term and CDs, is that I would say that if it helps your clients sleep at night to do so and diversify accordingly, but locking in everything also eliminates any opportunities that do emerge. And at this juncture, we are not forecasting a dire drawdown in the equity markets. We think there's still opportunities. And I think the same situation in the fixed income markets also exists. When the Fed does start cutting rates, there will be opportunities. As Mike said, it's better to hire a professional like Mike to do it, who understands where the opportunities are along the yield curve, than to try to do it yourself and just buy the wrong instrument. Okay.
Yeah, and that actually, I think that will apply to kind of the next question is, inflation's going down, rates are going down, but because inflation's going down, that doesn't necessarily mean prices are going down. So are wages increasing enough where the people don't feel the pain of the prices? Because as rates go down, some of them, even working people using that interest, are going to have less spending power. So are wages increasing enough to keep up with that, with the new prices? Because prices are probably not going down.
Well, from what I've seen, okay, when you think about inflation over a multi-year period, everyone talks about the current inflation rate, but the truth is you have to compound the effects of inflation over the number of years that you've seen it. So when people feel higher inflation, they look at prices today versus what they saw 3 to 5 years ago, which is considerably higher. And then they compare themselves in terms of their income. Has their income grown cumulatively over that same period? And by and large, the answer is no. The income has not kept up with the cumulative effect of inflation, especially for the lower end of the economy, of the population, the poorer end. And we see that with companies like Dollar Tree and Dollar General just having dismal numbers and just saying that their consumer base, which tends to be the lower end, is dramatically impacted by higher inflation, and that's caused them to curtail their purchases at Dollar Tree and Dollar General. At the higher end, more professional end, we have seen increases in compensation there. And even though that percentage has lagged, it is sufficient to afford the basics that most consumers have to pay for, food, housing, and other expenditures. So the higher end of the population is less impacted, but they see it as well. and they adjust their spending accordingly, but less so than the lower end of the population. So it's kind of a mix. It's kind of a mixed bag. It's significant because we're in an election year, and the majority of the population is not at the top 1%. So they have a say, and they're impacted by it. And many are, unfortunately, they're angry, and they want to know that there's a candidate that is really concerned about inflation and has some real policies to address that. So something to focus on tonight to see what those policies are. Okay.
Yeah, I think you said it well. A lot of people are emotional, especially emotional about their money and finances, and it's the job of the advisor to match the emotion. Well, we de-escalate the emotion with the data. So thank you for your question, your answer. The last one I have is can you touch a little bit about real estate, both residential and commercial? Are the banks pretty solid as far as commercial lending?
I would say in the banks, there's a dichotomy. The large, too big to fail banks, very highly regulated, have plenty of reserves. I think they're in good shape to weather any further drawdowns in commercial real estate. The smaller regional banks, some of them still have problematic real estate on their balance sheets that I know that the Fed and the OCC and the other regulatory bodies are looking at them very closely. There's been some pressure for them to merge with larger entities. In the past, where we've seen some regional bank failures back in May 2023, the Fed quickly stepped in to arrange for absorption of those banks. And I would say that the Fed will continue to step in to make sure that any additional issues will be absorbed by larger entities. So I'm less concerned about another accident like that occurring, because the Fed is vigilant and on top of it now. But that's not to say that there still are some issues out there that need to be worked out. But I think those are largely with very small banks, which tend to be things that we are not focused on and are largely avoiding. But larger financial institutions are in better shape. So you had a question on residential real estate as well, right?
Right.
Okay. Well, that's Mike touched upon that, with prices rising and if the Fed cuts, prices will continue to rise. That might lead to another bubble in residential real estate. From a recent analysis on home builders, they are certainly geared up to build more homes. Housing permits increasing is definitely a good data point. We're also seeing that they're building lower price homes versus building the big mega mansions, which were evidence of the home building boom in the past. But these homes tend to be more of the starter type, modest homes, more affordable, and they could also build them a lot faster. So hopefully the supply will pick up fast enough to prevent overall huge pickup. And I also think the other thing that's happening is the baby boom generation is going to downsize. Their needs for these large McMansions is going to diminish as they get older, and the cost of maintaining them is excessive and time consuming. So, and these McMansions tend to take longer to sell as well. So I think the supply of higher priced luxury homes could come under pressure. But I think at the lower end, where there's more demand by younger households, will be quite strong. So it's not a clear cut, the whole group moves the same. I think there'll be opportunities that we need to be prudent about dissecting where there are opportunities and there are risks. So that's kind of how I look at it at real estate. And you have to really think about which areas the home builders are focusing on, and also regional as well, because there are clearly areas of the country where people are moving out of and moving towards. So location, types of housing, and the local economies. So you really have to take a closer deep dive at it than a broad brushstroke on real estate. Okay.
Okay, and I guess this question is better worded as what are your plans, our plans for crypto and AI? Do we have investments in those areas?
Well, we do have AI investments across all the portfolios at a minimum in utility stocks that supply energy to the AI hyper data centers. And then we have riskier, higher growth names with the portfolios that can accommodate those within their mandate. As for crypto, we've been looking at it for many years now, ever since Bitcoin was out and I think I remember when Bitcoin was about $200, I was paying some attention to it. So we have familiarity with crypto. I know Jim and Paul look at it very closely as well. But in terms of public stocks, there are limited equities that play in the crypto space. Obviously, there's Coinbase, which is the one that's pretty well known. There are some crypto ETFs, like Bitcoin ETFs, that we all know that have been approved by regulators. Our current prospectuses do not allow us to invest directly in crypto, but we can invest in equities of companies that have crypto businesses, either mining or banking or trading. So those are businesses we can look at because they are regulated by the SEC. Will it be a huge component of our investment process? I don't think so. We're focused on the real economy, and crypto seems to be while it's a valid market and many hundreds of billions trade there, it's something that for I think long-term investors maybe is more of a short-term play than a longer-term wealth building type of asset. And I say that because we all know that crypto has huge volatility swings, which are driven by trading versus any fundamental type of analysis. But for companies that can capture market share and grow a business and generate earnings and have a strong customer base and growing revenues, that's a business we can analyze and understand. Whereas whether or not it'll be a huge component of our investment, it's likely not to be because of the underlying volatility of crypto. So that's all I would like to say on crypto. Maybe Mike or Jim, if you want to chime in and have any responses to that.
I have no view on cryptos because I don't fully understand how to value it.
I think your comments were spot on, Dan. I also think that crypto is a very interesting asset class based on the technology that's underlying the crypto. But I also think that part of crypto's, the opposite of its allure is the fact that central banks are looking into digital currencies. And I think that that's going to take some of the air out of the balloon in crypto. And crypto is also a waiting game. So it doesn't hurt to be in crypto. Some of the larger projects and coins, surely it can't hurt if you have reserve capital. But I think it is a waiting game.
And by the way, NVIDIA has played in crypto before it played in AI. It was a big crypto play in terms of mining, and they still provide the graphics chips for many of the miners. So NVIDIA is an amazing story that's gone from being a video game graphics chip supplier to a crypto mining enabler to the de facto leader in AI computing. So very few companies have dominated across multiple applications for their core technology. So it's truly a very interesting story and one that we follow closely. All right. Anything else, Cleveland? Or
I think that's good. That covers all the questions I've been asked and conversations I had. I will definitely get back to the advisors who I spoke with, and I'm always smarter when I listen to you guys, so appreciate the time.
okay, we appreciate everyone tuning in and listening. And as we said, feel free to reach out to us. You can contact us by reaching out to Cleveland, and we're happy to set up any one-on-one or calls that you'd like to have and answer any questions you might have. So with that, thanks for tuning in today. And we're America First Wealth Management at your service. Take care.
Bye-bye.
Thank you.